Hello once again for another live webinar with us from Phillip Nova. And what are we going to be discussing today is none other than US indices. Too late, or is it a good time to enter? And with us in the studio is professional trader David Lowe, and he will be discussing the ideal strategy for US indices in the coming months. And that's David right there that you see on the webcam, looking very cool as always. And David will also be touching on the overview and the technical outlook for the US equity indices, as well as talking about the opportunities that you can have with the CME Micro E-mini Options and why you should have a look at these contracts. All right, and who is David? David is a full-time trader, managing partner of Xmodeus Trading Group, PLT, is a consultancy specializing in providing bespoke trading strategies and coaching for private and corporate clients in the equity and commodity derivative markets. David has 24 years of experience in Malaysia-listed derivatives industry, and before starting his own consultancy, David held leadership positions in futures broking divisions of major investment banks in Malaysia. He is the immediate past president of the Malaysian Futures Brokers Association from 2018 to 2019. So you're very much in good hands and very experienced hands as well. David has spoken in numerous webinars with over 5,000 retail traders being present in the venue, at least before pre-pandemic times, right? And he
Yeah.
discussed he discussed products from BNB, CME, SGX, and the Hong Kong exchange markets. All right, David, if you're all set to go, I see your slides are up and your sound is good. Let me hand the reins over to you. David, go ahead.
Thank you, Sri, for that wonderful introduction. And how is everybody? Good evening and welcome to the webinar. We have certainly a very interesting topic tonight to talk about the US indices and generally in terms of the US stock markets. A lot of people have been asking whether this is the time actually to look for opportunities. The markets have come off, of course, from their highs. And now after the sell down, although yes, we have a background of things happening around the world, some of them are very worrying, but is it a time to look at the indices, time to look at the US stock markets to see whether any opportunities? And so this evening, thanks for Phillip Nova for hosting and also the sponsor CME for this event. We will discuss this particular topic hopefully in a very comprehensive way, right? So let's get on to the slides. For those of you who have questions, do put it into the chat box, and we'll take it at the end of this session. Okay. So while we go into the slides, I will switch off my camera so as not to distract you, and then we'll get into the materials. All right. So let's get on with it. All right. So US indices, too late or the best time now? Maybe this is the best time, or is it not going to be a good time, right? Is US markets are going to continue to decline, or this is the time where you can get back into the market? So let's explore the various game plans, the possible scenarios for trading the US equity indices. Okay, so let's have a look. But firstly, before that, a quick disclaimer. Okay, standard disclaimer. This presentation is for your general information and also for educational purposes. It's not a recommendation or an offer or solicitation to buy or sell any of the futures contracts or options contracts which is presented here. If you want to do anything, you want to have anything you want to action on from the ideas that you see tonight, please talk to your licensed intermediaries. All right. Okay, so this is what we're going to cover tonight. First part of the presentation, we'll talk about the overview and also the technical outlook of the current US equity indices. What are the key factors to watch for in terms of the equity indexes in the US? What are the factors affecting the price direction? Then we go in and look at the technical outlook and look at what is the current phase of the market momentum, right? And look at what is the current market psychology. And then we will study and explore different type of potential price direction scenarios. Okay, after having a look at all those scenarios, then we will see how we can use the CME Micro E-mini Options contracts to take advantage of the opportunities that may present itself at this current moment in the US indices. So we'll look at how to use the CME Micro E-mini Options contracts to trade the current market trend. So shall we go long, go short the market, or even more? We'll do something a bit more different. Today we'll talk a bit about volatility and how to take advantage of the market, even if you're not sure of the direction of the market. So we'll look at all micro E-mini options. So this is what we're going to cover tonight. Okay, so what you see right now are the main themes that are currently playing in the markets. You have, of course, the Russian-Ukraine conflict, right? And you have the pandemic that we've been experiencing for the last 2 years. Okay, some countries are already getting out of it in the endemic side of the scale. But there are also some countries like China, okay, which is a very important part in the global trade, okay, which have a very different strategy towards the pandemic. Okay, that could have an impact as well. How they handle this time of the pandemic, because you see cases rising in China. And China being such a very important player in the global supply chain, okay, what China does in terms of handling the current rising cases in the Omicron cases in China is also something that needs to be really monitored and watched closely. Of course, you have prices of commodity due to the conflict with the Russian-Ukraine conflict. You see the oil prices have been exploding. The WTI exploded to 130 plus US dollars per barrel, only to fall back because the last couple of days there was this talk about the China demand being lacking, and then also the last 2 days there have been talk of progress in the peace talks or the resolution of the Russian-Ukraine conflict. Right, and all these things would of course play into higher prices in terms of the energy costs and also the prices of commodities, because not only the oil prices went up, but all sorts of commodities throughout the world, whether it's soybean oil, crude palm oil, wheat, every single commodity went to prices that nobody have seen for a very, very long time. So these has very, very big implications in terms of inflation. 1 or 2 years back, the Federal Reserve had said that inflation was temporary, but it doesn't look like it's going to be temporary. It looks like it's here to stay. And then the Fed, these 2 days, which is 15 and 16, will be sitting to decide on the direction of the US interest rates. So in terms of looking at the inflation in the US, the annual inflation of the US has already accelerated to 7.9% in February this year. And this is the highest that has been seen since January of 1982. Right, and that's because, of course, mainly energy. Energy has been the biggest contributor to this hike in terms of inflation. About 26% or 26% of the component in terms of inflation comes from energy, and gasoline also is some 40% of the 38% of the contribution to the US inflation. So you can see in terms of inflation, the Federal actually has a lot in their hands to handle in terms of the policy moving forward, right? So in terms of the Federal Reserve policy, of course, these 2 days will be very, very closely watched. It is something that all traders will be looking at, because for the direction of the interest rate hike, already a lot of people are saying the 25 basis point interest rate hike is a foregone conclusion. Okay, they're not even thinking about that. They're thinking about what is the direction that the Fed is going to take for the next couple of sessions this year and next year going forward. So that will set the tone for the equity market going forward. So these are the things that has been happening, and these are the things that we closely watch in terms of what are the factors that be affecting the US indices. Now, one thing is guaranteed with all this thing happening is volatility. Okay, volatility is the sign of times. Okay, so if you have you've thought back, say about three and a half months ago in December, if you compare December and now, December will be last year December will be being a comparatively very peaceful month, right? So things have changed so much in this year. And but the beautiful thing, okay, why do I say beautiful? The wonderful thing is volatility, and volatility is what traders love to have in the markets. Okay, so in terms of looking at volatility, what do you do with volatility, right? In 2022, do you stomach it? Okay, you just sit quietly in a seat and don't participate, or you profit from it. Okay, so in terms of traders, I'm actually very excited with volatility. Okay, of course, volatility in terms of risk also may heighten the risk because of the price movements are more volatile, more extreme, right? But in terms of the opportunity in a market that's more volatile, the market that's moving in strong trends, these are huge opportunities in the markets. And we want to see this evening what sort of opportunities are available in terms of the US indices. All right, so this picture, okay, I want to present this picture to you to just let you ponder, right? In terms of investing, I think a lot of people are invest in stocks and trade in stocks. Some of you trade in futures as well. So in terms of looking at this picture on the left, of course, those of you who recognize this guy on the left is Captain Jack Sparrow, okay, from Pirates of the Caribbean, right? That show. Okay, he's got his one single ancient pistol, and on the right is Colonel John Matrix from Commando. Okay, so in terms of going into a battlefield, and we're talking about not this is not a Ukraine-Russian war comparison, but it's talking about going into battle in the investment, in the trading, or in the markets. Who will win? Right. So in terms of looking at the differentiating factors between these two guys is Jack Sparrow's got his single weapon, and Colonel John Matrix has got his bazooka. His you can see his body all with the grenades and all the bullets, and his big knife at the back of his back. There's a few more knives, and strapped around his legs a few more of those other types of weapons. So if you go into the battle, okay, and you are fully equipped with a lot of tools, okay, to fight this battle, okay, that is the key to winning, right? Because one single tool can only handle a very, very specific situation, okay, but you have multiple types of tools, then you can able to handle the situation better. Okay, so tonight I want to leave you with this thought, and later also we'll talk about, because we are going to talk about options tonight. Okay, and options is one tool that you need into a toolbox, because it's a very, very versatile and very, very adaptable tool. Okay, which is very powerful. So tonight we will talk about how to use this tool, look at it, explore this tool, and how to use it in capturing the opportunities that is available in the US indices, right? So this slide is just to give you a picture in your mind, right? So let's move on. Let's talk about the current technical outlook. Okay, what is the current phase of the market? Okay, so this market, does it have a chance? Does it have the chance to come back again? And when can we see this chance of the markets coming back again? Of course, when you say coming back, it's in terms of the going back up on the very, very long bull run that the US markets have gone over the last couple of years. Okay, so let's quickly now move and look at the S&P. All right, so what you are seeing now here in this your screen now is the S&P 500 weekly chart. Right, it's the E-mini S&P 500 charts, and what is happening currently? Okay, now I've drawn a couple of numbers here. Okay, 1, 2, 3, 4, 5, and these numbers denote the Elliott wave count. Okay, for those of you who are more familiar with technicals, you may be already very familiar with what is Elliott wave, but for those of you who are not so familiar, let me explain a bit. Okay, the Elliott wave theory is basically a theory by Ralph Nelson Elliott, who came out with this theory that the markets move in wave. Okay, early in the 1930s, he was a keen observer of the markets. The U.S. markets, the grain markets, and he saw that in terms of there is a very systematic count, very systematic pattern in terms of how the market moves. Okay, and then he conceptualized this theory of the Elliott wave. And in terms of looking at the Elliott wave in summary, is what he says is this: in terms of a trend, okay, an uptrend, there is a series of 5 waves. Okay, so you can see here there's a series of 5 waves, then followed by 3 what do you call that, corrective waves. So in terms of looking at the chart over here, the E-mini S&P futures weekly chart, okay, I've drawn here. What it has done is this: since the recovery from the waterfall drop during the year 2020, the markets have recovered and done this 3 wave. Okay, the first wave up from the low of the waterfall fall during the 2020, and then came back up from the first wave, came back down to the second wave, and did a very strong move from September 2020 up to end of last year. And this is what we call the third wave. Right, this is the third wave. You see the longest and most aggressive wave. And now what we are in terms of the wave count is what we call a corrective wave 4. Okay, now this corrective wave 4 is characterized by the momentum going down to negative zone. Okay, so when you see this particular chart at the bottom, you see this what do you call that graph over here, this chart over here, the waves over here. These are the what do you call that, the momentum indicator. So once it goes into negative, it's an indication and confirmation that it's gone into a corrective mode. Okay, so in terms of looking at the corrective mode, okay, the wave 4 here, okay, has a target zone. Okay, the projected target zone between 3,813 to 4,003. So this is the expected zone. Normally when wave 3 corrects into a wave 4, it will land into this particular zone. Okay, so currently we are still slightly off. We are actually nearing this zone. Okay, and what does this mean when it enters this zone? Okay, when it enters this zone, okay, basically you will find a bottom over here and then take the next move, the next impulsive wave up. The next impulsive wave up is the wave 5. Okay, and in terms of the theory of the Elliott wave, the wave 5 is the last leg of a bullish trend. Okay, so in terms of what is implying here, that for this trend in the E-mini S&P 500, in terms of this long trend since the pandemic started, there is still one last up leg that's not been completed. Currently, it is in the consolidation, fourth wave consolidation. Okay, now this particular fourth wave consolidation tends to be because the second wave, the wave 2 consolidation, the wave 2 over here, as you can see on the left side, is a very simple correction. That means it's corrected very fast and quickly moved to the wave 3, right? But in terms of the Elliott wave theory, when it comes to wave 4, when you have a very simple wave 2 correction, then you have a very, what we call a complex corrective wave 4. That means wave 4 it will take some time to correct, and there will be a lot of up and down, very erratic and very volatile move. Okay, so in this wave 4, you can expect a lot of the background happenings, like what we saw just now in the chart: the pandemic, the conflict, inflationary fears, oil prices, exploding commodity. All this will play out to make it a very complicated correction. Okay, so in terms of the wave 4, is foreseeing a very complex, we call it a very complex corrective mode. Okay, but in complex corrective modes also, it gives us opportunity as well. Okay, but in terms of that, remember this, that after the wave 4 completes around this target zone, okay, there is the opportunity for you to trade the 5th wave up. Okay, so the 5th wave up, okay, if it materializes properly, it will exceed the high. Okay, it will exceed the all-time high and make new historical highs for the S&P. Okay, so what this weekly chart is showing at this current moment is telling you that. Okay, so let's look forward to that. Okay, remember that we're going into consolidation in terms of the wave 4. So that's what the weekly chart is saying. Now let's move to a closer, smaller time frame. Let's go and see the daily chart. Okay. Now this is the daily chart of the S&P 500. So in terms of the S&P 500, you see on the daily chart is also in a corrective mode. Okay, so the most recent move in terms of the year starting out is what we call the ABC corrective move. Okay, so that was the Elliott wave. So it has completed the fifth wave in terms of the shorter term wave on the daily chart. It's completed the fifth wave, and now it's completed the ABC move, okay, right over here, ABC corrective move, okay. So what we can expect for the daily chart, okay. So in terms of the daily chart, we are talking about a trend that probably we'll be seeing it unfold in the next 1 month, okay, in the next 20 trading days. What you see unfold in the next 1 month, which probably will be this particular inference, okay, because what we have here is a bullish divergence. Okay, what is a bullish divergence? Basically, you are seeing prices going down, but you are seeing momentum, right? If you notice the arrow right at the bottom here, it is a momentum chart. You see that momentum is actually rising. That means momentum is not confirming the prices going down. That means as the prices going down, it's actually losing the selling momentum, right? So momentum is actually rising. So in terms of this kind of technical formation, so in terms of what we see in terms of a bullish diversion, that means that market has an opportunity to actually reverse to the upside for the next 1 month. Okay, so this is what is implying in the chart. Okay, so the downward corrective wave, okay, appears to be completed. ABC, okay, we see this bullish divergence appearing. Okay, so the downside risk for the time being may not prevail. Okay, may see it go on a technical rebound. Okay, but of course, just now we saw in the weekly chart that it has not reached the wave 4 zone yet. Okay, so for the next what is saying currently in this chart is for the next couple of weeks, you may see the S&P correct for a technical rebound. Okay, so that is the play in terms of looking at the daily chart. Okay, so that is for the S&P. So now let's go on and have a look at the Nasdaq. Okay, Nasdaq, a lot of people have their eyes on Nasdaq, right? All the technology stocks. So in terms of looking at the Nasdaq, okay, so the Nasdaq bulls themselves are also taking a rest, okay, taking a hiatus. They are also in phase of the wave 4 in terms of the weekly chart for Nasdaq. Okay, so it is in a corrective mode in terms of looking at Nasdaq weekly chart. Okay, wave 4 as well. Okay, very similar as well to the S&P. Okay, it is going into a wave 4 complex correction. Okay, as you can see right here, the momentum has also gone to negative, thereby confirming the wave 4 correction mode is there. Okay, the target zone for wave 4, where wave 4 has a high probability of landing, is 10,500 to 11,698. Okay, so this is the projected and calculated range where a high probability of the wave 4 will find a low over at this current area. Okay, but expect, because this is a corrective, a very complex correction, expect a lot of volatility as well, and a lot of what do you call that, up and down movement. Okay, consolidation, rangy movement in this particular zone, right? So again, as we said, after it completes the wave 4, okay, then it's going to try for the last impulsive wave 5. Okay, and this is another wave similar to the S&P. This wave 5 is expected to take out the wave 3 high and form new highs. Okay, so in terms of the weekly chart, okay, if you are looking to get into a position trade for a what do you call that, recovery into the fifth wave, it's not landed in the zone yet. Okay, so you need to look for signs of when it reaches this zone. Okay, if you are in technicals, then you look at the weekly charts to see any signals triggered for you on the upside. Look for it when it reaches this particular zone. Okay, this is where you hunt for any signals to go for the wave 5 move. Right, so this is what it says in the Nasdaq weekly chart. Let's move on and have a look at it in the daily chart. Okay, what does the daily chart? So the daily chart looks rather similar to the S&P as well. It's completed the fifth wave previously, right in the towards the end of 2021, right? And so towards the start of 2022, it has done this corrective wave down ABC. Okay, we see the bullish divergence as well. Okay, which are basically implying that prices or the selling pressure is coming off, and we may see a for the near term the upside is a technical rebound is coming on the way, right? So this is what it says, near-term upside because of the bullish divergence, right? So it's gonna Nasdaq will attempt a technical rebound foreseeably in the next couple of weeks. All right, so let's then move to, okay, we of course cannot ignore the Dow Jones. Dow Jones is also followed by a lot of people as a guide to and a measure and temperature of the US stock market. So we'll have a look at the Dow Jones. Okay, so in terms of the Dow, a very familiar picture as well. Okay, in terms of the wave count, it is in wave 4 as well. Okay, it falls into a corrective mode, and this weekly wave 4 is a consolidation. Is also okay, similar to the S&P and the Nasdaq. May look to be a complex correction as well. All right, so the target zone for wave 4 for the Dow Jones is 30,109 and 31,393. This is the projected range or the calculated range where wave 4 has a high probability of landing and forming a low, right? So if you're looking for the wave 5 upwards, okay, the zone to look for the wave 5 to trade the wave 5 will be at this particular range. Okay, so let's also have a look. Of course, very similar things are happening in this particular chart. Whether it's on Nasdaq, S&P, or Dow, very similar movements. Okay, momentum is also in the negative, right? So due to it being a very complex wave structure in this phase, also similar to the rest of the indices, expect more prolonged consolidation and heightened volatility in this zone. Okay, so this heightened volatility that we're talking about this year is very it coincides with this particular complex wave 4 count, right? So it's basically running concurrently with what the chart is saying. Okay, so in terms of looking at the daily, okay, daily, is it the same? Okay, also very similar pattern over here, similar to the Nasdaq and also the S&Ps. It's finished the ABC correction. It looks like also has the divergence, the bullish divergence. So expect to see the temporary reprieve to the upside. Okay, so for the next couple of weeks, you can see a possibility of the Dow Jones taking a technical rebound upwards. Okay, so these are the what do you call that? The technical outlook and the phase reading for the US indices. Okay, so what are the opportunities that we can conclude over here is number one, the US indices in terms of the weekly charts. It's coming on a complex consolidation. Okay, there will be volatility. There will be large ranges to trade, which is very interesting. Okay, you can go on a sideways consolidation range. Okay, but very volatile. So there's a lot of opportunity there in terms of volatility. Okay, it will land into that particular zone that you saw. Okay, and those zones are aware that if you're going to position yourself for a wave 5 upsurge, the last impulse wave for the US indices, then that's where you look for any of your technical signals, or that's where you look for any particular signals to take a position for the wave 5. Okay, in terms of the daily charts, of course, very similarly, we are talking about trading and potential technical rebound on or a view that there will be upside over the next couple of weeks. Okay, so those are the what do you call that, opportunities that's possible looking at this particular technical charts. All right, so we'll keep that in mind and see how are we going to apply the next part of our presentation to those ideas that we saw just now. Okay, so let's now go and talk about what are the opportunities available with the CME Micro E-mini Options contracts. Okay, So the Micro E-mini equity index contracts, of course, this is one of the most successful launches of any contracts in the exchange CME, right? Launched a couple of years, and of course, it has been beating a lot of new records. And even in January 2022, the volumes have continued to make new records, right? New records in the Micro E-mini Nasdaq futures. Okay, daily trading volume above 1.7 million, incredible, right? Micro E-mini S&P futures as well, a daily average daily volume of 1/million. Micro E-mini Dow as well, 270,000. Even the E-mini Russell, 2,000 in January is trading 200,000 contracts a day, right? Incredible. Now the other thing is this: the Micro E-mini equity index futures and options also had a record ADV of 3.8 million contracts. Okay, so in terms of in January, the micros itself, the micro equity indexes, futures and options itself represented 43% of the overall all the equity index ADV, right? That's an incredible thing. There's just so much activity in the micro E-mini space, right? In the future side, and of course now you will see the activity also on the option side. Okay, so let's have a quick look at the options, performance in terms of the activity, right? So in terms of the last quarter of last year, 2021, there is a record in terms of the E-mini options. Okay, so the micro E-mini options, for the micro E-mini, there are two options contracts on the indexes, which is the S&P 500 and also the Nasdaq 100. So in terms of looking at that, you're looking at a record of 14.1 over 14,000 ADV in the quarter of 2021. So very, very active in terms of the daily activity, right? And in December, there was a huge volume surge. It reached nearly 3.1 million contracts traded in December 2021. Okay, so that's a very incredible achievement for an options contract, right? So in terms of also looking at the non-US hours, I mean the Asian hours, and before the US cash market open, also has seen a lot of activity. So this is this is what you call the volumes on the non-US hours. You can see that the ADV has been picking up as well. So volumes have been very, very growing very strongly as well, right? So it hit all-time high in February of 2022 as well, with 5,600 contracts per day, and these are non-US hours, right? So in terms of the non-US hours, the average in terms of approximately 29% of the daily volume is traded in the non-US hours before the US markets actually open, the US cash markets. So you can see even during our Asian hours, the activity is very, very strong. Okay, so this is a fantastic contract to consider because of the very versatile and very adaptable to a lot of different situations. So we're going to explore what are the situations and what are the opportunities we can use this contract. All right. So yes, so let's move on. Okay, this is a quick look at what the options contract specifications is. Okay, so as we say, in terms of the options on the Micro E-mini, there are two the indices that has options. The first is the S&P Micro S&P 500, and also the Micro E-mini Nasdaq 100. Okay, so the contract size, of course, this is the size down from those big brothers E-minis. Okay, this is the similar size with the Micro E-mini futures as well. The multiplier is $5 times the index points. When you talk about calculating the P&Ls and the premium, you use $5 times the index points. And in terms of the Nasdaq 100 options, is $2 times the index points. Okay, so the underlying contract unit, the underlying options, of course, is the Micro E-mini 500 futures, right? So this contract, the options, trading basically options on the futures, right? Options on the Micro E-mini S&P 500 futures, and the other one is the E-mini Micro E-mini Nasdaq 100 futures. So that's the underlying. All right. So the minimum price fluctuations are here. Okay. So in terms of the quotes, when it's running on your screen, these are the minimums. If the options premium is priced above $5 index points, then it's 25 in quarter index points per move. If it's small below 5 index points, then it's 0.05. Okay, similar for the options on the Nasdaq 100. Okay, so these are the product codes. Okay, there are a lot of actually options available in terms of the what do you call that, of the micro E-mini options. There are the quarterlies, they are the end of months, there are also the weeklies, right? So in terms of every single week, at the end of the week, the Fridays, they are available different types of expirations. So you can trade your options, you know, in a medium term range, or even in the shorter period. Fast, if you're trading, quick development in the market, you can even trade the weeklies. So a lot of choice in terms of what are the options available for you to trade. Okay, so of course traded on CME Globex, almost 24 hours, and these are the listing cycles. Okay, so how many options listing cycles? You have the 2 quarterlies. Okay, so this is based on it coincides with the quarterlies of the futures itself. There are 3 end of the month options, and there are 5 Fridays. Okay, 5 options that end. 5 Friday options at end of the week. Okay, so which is the weeks 1, 2, and 4, and 2 serials. Okay, 2 serials means that the non-quarterly 3rd Friday monthlies. Okay, because the E-minis when they expire on the 3rd Friday of the month. Okay, so don't get too what do you call that, confused with this. Okay, if you're starting out, but just remember that there are a lot of options, different types of maturities. Okay, different types of length of maturities that you can choose from. Okay, so in terms of the quarterly options, they are American style. That can be what do you call that, exercise at any time. And then for the rest of the weeklies and the end of months, they are European style exercise, which we will talk about later. What are these European and American exercise, right? So for those of you who are a bit new to options, don't get too what do you call that, nervous. Okay, I will explain how this are all traded. All right, so this is the contract specs, just that you know. Okay, let's move on and see why you should trade the options on the micro E-mini. Okay, basically it's a smaller size contract, right? So as the term says, micro E-minis, right? So in terms of size, it's a more flexible. Okay, you can trade multiple sizes. Last time when you trade the E-mini options, it could be a bigger size. Okay, this does not give you that much in terms of the ability to position size. Okay, so those of you who are advanced traders, you know the importance of having the ability to size your positions in terms of increasing your size, downsizing your exposure and all that. So the smaller contract gives you a lot of more flexibility in terms of using position sizing. Okay, the second, of course, the versatility, right? In terms generally across all types of options, it's a very versatile in terms of building what types of trading strategy for different types of market situations. Okay, just now we saw the weekly chart on the indices have a different type of movement that you can trade. The dailies will have probably a more straightforward type of trend as well, right? So you can use options in terms of looking at what sort of view you want to trade, or what type of views you want to express in the market. You can use the micro E-mini options in a very flexible and versatile way. Okay, and because it settles to a micro E-mini futures contract, you are definitely settling into a very liquid contract, right? We already said that the micro E-mini futures contract is one of the most successful and most highly actively traded contract in the CME, right? So these are the 3 very attractive what do you call that, features of micro E-minis and why you want to trade them. Okay, but let's move on to a bit more general in terms of what are the main benefits of trading options by itself as a product. Okay, of course, the first thing, we already said that a couple of times, flexibility, right? That's the key. Flexibility, versatility. Okay, the contract can be used in trades of different types of situations. Okay, so in terms of tonight, when we look at we're talking about volatility, right? The key word here, volatility. How can we use, later we'll see, how can we use options to trade volatility? Okay, so you are assured of volatility, but you may not know for sure where the volatility is going to go. Is it going to go in terms of the direction of the market? Okay, so is there a way to trade the market without actually knowing where the market is going to go, but you know that volatility is going to be very, very high. Okay, so that's a way to do it. After, let's look at some of those option strategies that can do that. Okay, so there are a lot of different types of combinations when you use futures with options and use different types of the calls and puts options in combinations. You get a very, very large what we call it combinations of possibilities. Okay, so that's the beauty of options. Of course, that's also the makes options a bit complex. That's why people say that options can be quite complex, right? It depends on how you combine it, right? Yeah. So the second very important feature of options is, or benefit of options is leverage. Of course, similar to futures, right? Options, you actually pay a smaller outlay in terms of the position that you have. So in terms of returns, when it pays off to you, it's got a very good payoff in terms of the returns. Okay, and also that is because of the power of leverage. Okay, and then the last part of options, which is not available in futures. When you're trading futures, this particular what do you call that feature that's not available in futures is called the limited risk for the holders of options. So if you hold or buy the option, okay, your payoff rate, your payoff diagram or curve or graph, what you say, that there is a limited risk in terms of the maximum you can risk, right? The maximum you can risk is what you paid for the option, okay? But in terms of the upside, if the markets move for you in the direction that you have a view on, then you can actually, in theory, have an unlimited what do you call that return, okay, or unlimited profit, okay. So that's the beauty of holding an option, okay. So let's go in and explore the various different option strategies. Before we do that, okay, just to make sure that everybody's on the same plate, I have to go through some of the fundamental foundations of options. So those of you who are a bit more, what do you call that, familiar with options, do bear with me this next couple of slides. I need to explain some of the basic concepts of options and what affects options prices to those who are new in this subject, okay? So basically, in talking about trading the options, there are two different types of options you need to know. The first is the call option. The second is a put option. Okay, so what is the difference between a call option and a put option? Okay. Okay, the call option. Okay, if you have a call option or you hold a call option or you buy a call option, a call option gives you the right, okay, the right but no obligation, okay, to buy an underlying asset. Okay, so see, tonight we're talking about US index. Okay, so it gives you the right and no obligation to buy, say, a S&P 500 futures contract at a specific price. Okay, that's as simple as the definition of a call option. Gives you the right but no obligation to buy an S&P 500 futures at a particular price, and this particular price, this very specific price, is called the strike price or the exercise price. Okay, then what is the put option? The put option is opposite. It gives you the right, okay, you have the right but no obligation to sell, say, an S&P 500 E-mini Micro E-mini S&P 500 futures contract at a particular price. Okay, and that price is of course called a strike price or an exercise price. Okay, so in terms of the definition option, that is what we call that, as far as the simplicity of it is. Okay, so if you hold a call option, okay, you buy a call option or hold a call option, you have a right to buy something at a very specific price. Okay, but you have no obligation to buy it. When the time comes, if you don't want to buy it, okay, it's okay, right? You don't need to exercise it. The put option is the opposite. You have the right to sell. Okay, so we start with these very two basic things. Okay, now we expand it a bit. Okay, that's a buyer. So when you buy, you have to pay something, right? So the right to hold a particular option, whether it's a call or a put, you have to pay something, and that what you pay is called the premium. Okay, what you pay is the premium that you pay if you're a holder. Okay, so the guy that sold you that option, who wrote the option to you, of course he received the premium, okay, because that is the price of the option. Okay, so what you pay is called the premium. Okay, and you've spoken just now that the price that you're able to buy or sell is called the strike price. Okay, so for example, over here, right at the bottom, as you can see, a call option on the Nasdaq. This is a Micro E-mini Nasdaq with a strike price of 13,800. Okay, what does that mean? Okay, if I have a call option at 13,800, that means I have the right to buy the Micro E-mini Nasdaq futures at 13,800. Okay, I have the right to buy it, but no obligation. Okay, I have the right. Okay, so what is a put? Okay, if a put, then I have a put option. In this example, I have a right to sell the Micro E-mini Nasdaq futures at 13,800. Okay, so if I hold a put, I have that right. If I hold a call, I have a right to buy. I hold a put, I have a right to sell. Okay, at that price, the 1300 is called the exercise price or the strike price. Okay, I hope that is easy to understand. Now we move on to a few more concepts, go a bit deeper. Okay, exercise style. Okay, just now we said exercise style. Okay, don't be too concerned about exercise style. People mainly trade, and unless you're a super professional, you play the cash market as well in the US markets, then you'll be even more, you want to delve into. Basically, American style is you can exercise the option at any time prior to expirations. Okay, so in terms of the what do you call that, the quarterlies, in terms of this micro options, it is American style. Okay, but for the rest, it's European style. Okay, so European style, you can only exercise on expiration. Okay, don't ask me why they name it American and European that way, but okay, American anytime, European only expiration. Okay, so in terms of sometimes the pricing, the American option can actually may be more valuable because it has the ability to be exercised anytime. Okay, it's usually is more pricey, not always, but usually it exceeds the price of the European option. Okay, this is just for you to know. Exercise style. Okay, underlying commodity, what affects the options pricing? So options pricing, one of the most important part, of course, is your underlying asset, what the index is doing, what the say the Nasdaq or the S&P is doing. That will have a big impact on the price of the option, right? Later we're going to see why. Okay, because if you hold a call option, which is the what do you call that, a right to buy the index at a certain price. If the index is going up, then of course that will be more valuable because as the what do you call that, the index goes up, the value of your options, your call options will go up. Okay, of course, if you are holding a put, if the underlying index is going down, then your put will be more valuable because basically your position is a short, or you have a view that the market is going down. Okay, so in terms of one of the biggest what do you call that, effects or factors that affect options pricing is of course the underlying asset value. Okay, time to expiry is very important as well. Okay, the longer the time to expiration, of course, the higher the chance the options can get into what we call in the money or can make money, right? So the shorter the time until expiration, the lower the option price. So the options with longer tenures, okay, a longer time to expiry, date to expiry, will tend to be more expensive. Okay, because time has a value in terms of option. Okay, time is actually a very important part of options, and something that you need to what do you call that, remember is let's say, for example, if you hold an option, okay, the option is actually has what we call time decay, right? So if the price of the particular option or the underlying is not moving anywhere, and as you hold that particular options, as you hold it to the end of expiry, it will actually expire worthless. Okay, so time is a very important component of options and options pricing. Okay, the last component called volatility is also very important. Okay, in terms of higher volatility markets, okay, the options will be what do you call that, more valuable, or more in terms of their price, they'll be higher. Okay, because there is a greater chance that particular option can go into what we call in the money, right? In the money, that means the option is actually making money. Right, so with higher volatility, you have a higher chance of that happening. So in terms of option pricing, with higher volatility, your options will be priced higher. Okay, I hope everyone is still with me. Okay, so strike price, of course, we spoke of that. I will not what do you call that, expand too much, but I want to talk about this thing in the money, at the money. Okay, interest rates, quickly cover that. Interest rates generally, when interest rates increase, call prices will increase. put prices will decrease. Okay, and dividends as well, because dividends takes the brings down the price of the underlying stock. You will have a inverse effect. So if dividends go up, call prices will go down and puts prices will increase. Okay, so these two factors are less compared to the rest of the factors we looked at up. Okay, so let's talk about in the money, at the money, out of the money is important. Okay, so depending on which strike price you bought your particular or sold your particular option, okay, it's very important to know what's in the money, at the money, and out of the money. Okay, so let's say for example your E-mini Micro E-mini Nasdaq MNQ is trading at 13,800. Okay, now a call option, if you have a call option with a strike price of less than 13,800, okay, market as 13,800, if you have a call option at 13,700, you are in the money. Okay, that means you have the right to buy the MNQ at 13,700. It's now 13,800. Okay, you're already making money already. This is called in the money, right? Likewise, a put option as well. If the market is trading at 13,800, okay, and then you have a right to sell the MNQ at 13,900. Okay, you have the right to sell at 100 index points above the current market. Then you are what you call in the money. Right, so if the prices of the options is trading, your strike price is similar to the where the market is trading now, it's called at the money. Okay, and if it's a market, if your call option is more expensive or trading strike price is higher than the current market, then it's what we call out money. Okay, so this in the money, out money, or at the money is where your strike price is in reference to what the market is trading now. Okay, so these are the basic concepts of options. So let's now get on to see whether you can see the strategies. Okay, let's look at the strategies. Okay, first let's talk about the buying a call option. Okay, this is a very interesting payoff diagram. Okay, what is a payoff diagram? Okay, payoff diagram is what you see here. Okay, on my right side. Okay, basically what we are charting is we are charting in terms of profit. Okay, this axis is the profit and loss. Okay, this is the price of the particular index. Okay, let's say for example the price of the index going here from 0 onwards. Okay, so if you're buying a call, okay, if you own a call, again, what's a call? You own a call, that means you own a right to buy the index at a particular price. Okay, so let's say for example the price is this particular price. Okay, of course you pay a premium. The premium is A, that's why you see here this the strike price you buy, the premium is over here. Okay, you buy, you have what we call a profile with unlimited profit and limited risk. Okay, so when you buy a call option, okay, what is your risk? Your risk is basically the premium that you pay. Okay, so what you pay for the premium to hold the particular call is the risk, that's all. So if at the end of the time when it expires, okay, if it expires in the money, of course you make the profit. If it expires, say here, okay, the price expired here, okay, all you lose is your premium. Okay, so that's why it's a very, very interesting return in terms of the risk reward return in a call option. Holding a call option is a unlimited profit and limited risk. Okay, so let's have a look at an example here. Okay, so let's have a look at example of a micro E-mini S&P options. Okay, so if you are bullish, okay, I'm bullish on the S&P. Okay, I feel in the next couple of weeks, because we saw that chart just now in the daily chart, that there's a possibility that possible that they can go up. So we go in and buy a call option. Okay, so we choose this particular call option, which is the quarterly MESH2, which expires March 18. Okay, MESH2 actually expired March 18, end of this week. Okay, and this was designed when I designed this particular slide, it had 12 days to expiry. Okay, so this is the time the market was trading at about 4320. So this is something very close to this, called the at the money option. Okay, the March at that time futures was trading 4320. This is a strike price 4320. That means it's at the money. What is the premium? Okay, so the premium is 89.75 index points. Okay, so what does that mean in terms of monetary terms, it means that you have to multiply the index by the cost, which is $5 multiplied the dollar value multiplier times the 89.75. It means you pay 448.75 for holding this particular call option. You have a 12 days to expiry. Okay, so in terms of looking at the right side, you can see how the profit diagram is. Okay, so you can see the break even. The break even is 4409.75. That means that if the S&P moves above 4409.75, then you're in the money. Okay, the futures price is the current at time when we designed this. The futures price was trading 4320. Okay, so basically, when you add the premium that you pay to the price of the strike price, then you get this particular price where you break even. Okay, so you can see the profile here is if the S&P were to drop below the 4250 or go down to even 4000, your maximum loss is the premium that you paid, which is $448.75. Okay, so that is your loss, your limited loss, which is the premium that you paid. Okay, so this is how a call option looks like if you buy the options on MESH2, okay, which is the March expiry on 18th. Okay, let's move down to look at a put. Okay, yeah, buying a put. Okay, buying a put has a very different view. Your view is you're bearish on the market. Okay, so your implementation is buy a put. What does the put gives you? It gives you the right to sell the index at a particular price. Okay, right, but without the obligation. So it's the same here. You can see over here at the chart, if the prices were to go down, okay, if the index were to go down, then you make money. Okay, if the index go up and you are not in the money, then you will expire worthless. The maximum can lose is only the premium that you pay. All right. Okay, let's look at example. This example is also on the E-mini, Micro E-mini Options. Okay, we're looking at the S&P Micro Options. Okay, which is also 4320. Market was trading also similar to the call 4320, which is at the money. Okay, what is the premium? The premium is 89. Okay, and the cost of this in terms of the US dollars is 445. Basically, multiply 5 by 89, you get 445. And then in terms of looking at your profit potential, is unlimited if the market goes down. Okay, and if the market goes up or goes against you, your maximum loss is 445. Okay, so by the way, all these prices you see, I sourced it from the CME website, the CME Quick Strike Strategy Simulator tool. Okay, this is a tool that I encourage you to go and explore on the CME website to have a look. Okay, right. So this is how the basic two puts and option strategies are used. Okay, now let's consider other strategies. You can see here, you can also sell a call. Okay, so sell a call, you are market view is bearish, but you're basically, instead of a holder of an option, you're a seller of the option. Okay, so a seller of an option has a very different type of a payoff diagram. His risk is unlimited and his rewards unlimited by the option, what do you call that, premium that he received. Okay, so it's a very different type of strategy. So in terms of selling a put option as well, okay, your market view is the markets are going up. So you take the premium that the holder of the put option gives you. Okay, your risk is unlimited. Okay, if the market goes down, but if the market goes up, you keep the premium. Okay, so that is a seller. Now let's talk about this strategy. We want to talk about how to profit from volatility. Okay, so we say the markets are very volatile, but you may not actually know what do you call that, the direction where the volatility goes. Okay, so what we have is we have what we call a strategy called the Long Straddle. Okay, what you do is basically you have a long call and long put at the same time. okay, at the same strike price. Okay, the rationale is basically the trader takes the position to profit from high volatility, okay, regardless of market direction. Okay, he doesn't worry about the market direction. He knows the volatility is going to come in, but he don't know which direction the volatility will take. Okay, so the market stands to gain from the market. It moves outside these two particular range. You can see over here, okay, this particular point, it moves below here, he's in the money. If he moves above here, this particular price, he is also in the money. Okay, so that's it's a view, that's the rationale the trader trades when he trades the long straddle. So let's see how it's done. Okay, so this is the again the same contract, the MESH. So we buy one call and buy one put. Okay, so those are the calls and puts we saw just now. So that's where we put in. But the cost of the strategy, of course, now you have two. You're holding two options, so it'll be slightly higher. It's 178.75 index points. So you multiply by 5. The cost of this strategy is 893. Okay, so date to expiry is 12 days to expiry is 12. Okay, so why would you go into a trade like that? Okay, so basically when you're trading the March 18, okay, remember that this week is the FOMC week, right? So the decisions on the interest rates going forward is going to make this week. Okay, it's going to be made before the expiry of this particular option. So you are expecting, okay, that this week will be very, very volatile. Okay, so as you can see on the graph over here, you can see the two break-even points. Upside is 4498 and downside 4141. So if markets were to swing wildly either side, okay, then the trader will be profitable in terms of this particular strategy. Okay, so in terms of looking at this strategy, it's basically looking for bursts in the volatility. Okay, the trader may not know which way the volatility is going to go, whether upside or downside in terms of direction of the market, but what he knows is volatility is going to increase. Okay, so in any situations in market where you have this kind of occasions, okay, this kind of very particular situations. A couple of years back, of course, you had the things like the elections, the U.S. elections, the Brexit decisions, and all that. Those are the what do you call that? Where situations where straddles are a very good strategy to trade, where you know that it'll be very volatile, but you may not know where the direction of the market will go. Okay, so this is an excellent strategy to trade the volatility. All right, so this again is long straddle, slightly modified, okay, compared to the straddle. Okay, it has the two different strike prices. Okay, so you have a more flattish bottom. Okay, so this particular is also playing on the volatility. Okay, so you have other things like bull spread as well. I don't have time to cover all of them, but these are the other possible scenarios that options can give you. Okay, just have a quick look at what are the other things and payoff diagrams you can see. Okay, bear spreads also can. If you are moderately bearish, okay, you can have this particular strategy. Okay, it's very similar to a put option. Okay, so in volatile expectations, we looked in long straddle, long straggles. Okay, also a short butterflies. These are another strategy very similar to straddle, but also try to reduce the cost of that particular strategy. Okay, by capping the upside. Right, you can see it's like a butterfly. Then for those who believe that the market is not going anywhere, also there's a strategy. It's called neutral expectation. You can do a short straddle, a short strangle, or a long butterfly. Okay, so that basically gives you a full look of what are the possible combinations that you can use options for different types of market situations. Okay, so now let's talk about this particular very important tool which you want to use, that you want to also use to study your options. You can go to CME. Okay, there's a link over here. Okay, go to CME. You can also just type in the search what do you call that box, the quick strike. They'll take you to this very important tool. Okay, there are a lot of tools here for pricing, for volatility. Okay, and this you can calculate the fair value of the options. If you want to go deeper into Greeks as well, there are Greeks on the options, the volatility, and all the correlations. Okay, so I encourage you to go into the CME website, okay, and quick search this quick strike tools for options. Okay, And then also this particular, I recommend you to have a look at this newsletter as well. If you have a scanner, you can scan the particular little T-Rex there. It'll take you to this CME trading room. It's a CME trading room is where you can get an expert analysis newsletter, right? Every 2 weeks it comes out and it tells you which trading ideas you can look at in the market. Okay, whatever futures contracts or indices or even options strategy that you can look at. So check this out as well. All right, so this is the end of my presentation. I will share with you this slide again. Okay, who will win the battle? The question is, do you have the tools to win this? Okay, so now I'm going to pass you back to Sri, and let's see what questions we have. Sri, back to you.
All right, thank you so much, David, for walking us through the various strategies that you have highlighted. I've gotten a better understanding of the strangle, the straddle, and the butterfly. All right, we have some questions on hand for the rest of the audience. If you have questions for David, please head down to the question box that you can see on your control panel. It's somewhere at the bottom. Just go down to that tab and type in your question there, and we'll address it as soon as we can. All right, the first one from YouTube is a question from Yo. He's asking, do you think the S&P 500 and Nasdaq will fall further?
Okay. So will the S&P and Nasdaq fall further? Okay, in terms of looking at the weekly chart, we saw just now that the zone, we have not reached the zone yet, right? So there's still possibility, okay, that in terms of the weekly correction, okay, you will still possibly land down lower to those zones, because those zones that you saw just now, that which the boxes, those are the high probability, which is also the Fibonacci 50 and 61% what you call that retracement zone. So those are high possibility zones. So there is still some downside risk. Okay, so for the daily chart for the next couple of weeks, you may see the index what do you call that come back up. Okay, so you have a trading opportunity there for the next couple of weeks, but in terms of, say, in the next 1 or 2 months, there's still a possibility in terms of the weekly chart, next 20 weeks, that there's still possibility of landing lower in that particular zone. Okay, so when it lands in that particular zone, then basically you can put in your charts an alert when it reaches those zones to see any of your technicals are showing the weekly charts any buy signals or not. Okay, but in terms of looking at the downside risk, there's still some residual downside risk in terms of the Nasdaq and the S&P. I hope that answers the question for you, right?
All right, David. Next one is from Joe. His question is on silver. Well,
Silver.
yeah, what's your thoughts on silver? It seems like it's falling downwards once more.
Silver. Okay, I don't have the chart in front of me. Okay, so okay, good. A silver question in the US in this, but never mind. Okay, in terms of all those commodity charts in general, okay, this taking things in general, it has all broken out, okay, into the high prices. Okay, so in terms of the weekly charts, if you look at the weekly charts, all these are already in the third wave. Okay, so in terms of commodities, there's still a very strong move. Okay, although I don't have specifically the silver prices off my head. Okay, but I tell you, this particular technical retracements will still see very high possibility of higher prices going forward. Okay, so the view of silver and commodities in general is the upside is still may still continue to persist. Okay, because those situations, those conditions in terms of supporting higher prices of commodities are still there. Okay, so I hope that answers Joe's question.
Hey, David. With the war situation right now, I mean, it's very tough not to talk about the war because that's very much at the top of our minds as a trader at the moment. Right now, we're going to have more talks between the two warring parties, and there's going to be countries, representatives from neighboring countries to come and mediate the situation. So how is that going to impact the indices and I mean maybe just to sum up on what you've covered today, why we should be looking at the options contracts for the US indices.
Okay. Always bear in mind, of course, when we are trading, okay, in terms of what are the background events that are happening, okay, or whatever data is happening. Let's say, for example, this week is the FOMC meeting, okay, and then the last couple of weeks have been the conflict in Ukraine, the rising prices of commodities and all that. Now, these are the background situations, okay. In terms of these background situations, now if you think of it a bit more deeply, in terms of, let's say, for example, you're trading the US indices, okay, when something happens, whether in Ukraine, whether it's a peace talk or going to a resolution or non-resolution, can't agree, continue to fight, all these situations, when it happens, what actually moves the prices is the traders, right? It's the traders that put in their orders and their reactions to these events that then reflect itself in the market, okay? So the only way to really, what do you call that, methodically trade the market is, for me, in terms of this kind of very highly volatile situation where you don't know what's the outcome, is to go into the charts and look at the technicals. You need something a bit more objective for you to make your decisions, okay? So from what we see in the background just now, all these various big factors playing to the market, we can also see coincide with the fourth wave consolidation. So that's why, in terms of looking at the charts, the weekly charts is now going into a weekly consolidation, and this is a complex situation, a complex consolidation. That means the market may stay in this consolidation and very volatile times for a few months or half a year to in going forward, right? So this is the situation currently, right? So in terms of whether talking about be it the war or what's going to come out, I mean, it's very difficult to gauge what is going to happen. Of course, to us, I mean, we hope peace will prevail, right? But it's very difficult to see the situation going forward. It's a very touchy and very complex situation, okay? So instead of focusing our eyes on what is actually happening there, which you can't predict, okay, then you take control by looking at charts and see what are the possible scenarios, what the charts tells you, okay? So that's how, when I trade, I use the charts to guide me, because in terms of looking at events, it's almost difficult because I'm not the guy on the negotiating table. You don't know what's going to happen, right? Okay, so I hope that gives you a bit of clarity in terms of looking at how to trade in these very turbulent times.
Hey David, this question is from Chiu. He's asking for the options charts which you showed earlier with, I mean, those are charts for the US indices. What kind of indicators do you typically use for when you're analyzing the options index?
Okay, so first, of course, you judge before you trade the options, okay? So options, you see just now got two graphs, right? So some of the graphs are the payoff graphs, okay, which you can go into a CME to see how the option strategy will work out, okay? Of course, start with the charts, your normal charts, okay, to determine the direction, what do you call that, that the market is going to go, okay? So if you feel that, okay, let's say, for example, if you're trading the daily charts, what the daily charts say is that there is a possible technical rebound to the upside, okay? So, okay, that means to say your view, okay? From there, you form your view of the market. So you feel that, okay, next couple of weeks, from my technicals and from what I see, okay, there's a possibility of upside. So I will trade the bullish side, okay? So after you have determined the direction, then you choose your strategy, okay? Whether this is going to be aggressively moving up. If you don't think it's a very aggressive move up, okay, only moderately bullish, then you may do what we call a bull spread. Just now we saw some charts on a bull spread, or you can buy a call. Okay, you can buy a call for the next for the next 3 weeks. Okay, for a call that lasts for the next 3 weeks for your view, to express your view. Okay, so what the options does for you in terms of what do you call that? The adaptability or versatility is this. Now, you can, of course, even long the futures. Okay, then another way is to long futures. If you feel that the Nasdaq or the S&P is going to go up, you can easily long it. Okay, but you can buy an options because the options will give you a profile where you have limited risk, and unlimited profit. Okay, so depends on how you like, what type of a profile that you like. Okay, of course nothing is for free lah, because when you buy or hold option, you have to pay the premium. That's the price that you have paid. So if the prices don't move up as expected, you also lose the premium. Okay, there's always a, what do you call that, is a risk reward ratio, or a what do you call that, cost benefit to it, right? So always pick up your direction first from your normal charts, read the direction of the market, okay, and then only decide whether you want to do it with futures. Okay, if you can do it with futures, if you like to do it with options because that gives you more versatility, okay, then you go with it. Okay, but if you also feel that there's going to be very volatile, but you don't know where the direction is going on because of very specific event, okay, like this week is the FOMC, then you can also do things like straddles or strangles. Okay, I hope that answers your question.
All right, thank you so much, David. Thank you for being a wonderful audience, and thanks to David for the valuable insights for today. Meanwhile, for the rest of our audience, and of course our speaker as well, do take care and stay safe. Until our next live webinar, we'll catch you then. All right, good night. Take care.